All right. Hello, everyone. Happy Monday. Welcome to your weekly market check-in here with myself, Greta. I'm your host. I'm joined by Derrick Oldensmith, the head trader at T3 Trading Group and the leader of T3 Live's Pro Desk virtual trading floor. Quickly, before we get into any market-related discussion, here is just a quick disclosure of Derrick's current positions as of our recording here today on May 11th, 2026. Again, Derrick is the head trader at T3 Trading Group. So the title of our stream today, Derrick, is Record Highs in CPI Week because, wow, the records just keep coming. S&P 500 rising to a fresh record today as chip stocks continue to march higher. So what do you think about this run that the market is on, and is it ever going to end?
So the run that the market is on, I think, is very appropriate when you understand kind of what's leading it and where it's coming from. It's semiconductors, it's AI capex spend. When you think about it, AI capex spend is basically acting as $1 trillion per year stimulus to the economy for now. So unless something comes along to derail that, you just have to assume that it's going to continue. And it's so easy to look at some of these semiconductor names and Micron and SanDisk and say like, wow, these things have gone too far too fast and they have to go back down. In reality, Micron is actually still fairly cheap on like a forward PE multiple because their earnings expectations have increased by so much. There is something to be said about extension and looking for shorter term shorts at the right degree of extension in the up move on some of these things. But those shorter term shorts should give way to new longs again as you get bull flags and as you get like maybe pivot lows for trend continuation. I don't really see any reason why this rally should end. As I say that, inflation is becoming a little bit of a problem again. We have CPI numbers that are coming out this week. We had Jerome Powell mention that core inflation's at 3.2% the last time he spoke during the last Fed meeting. That is too high. So the question is, will that ever give way to any further tightening? And in the short run, I think that the answer to that is no. I think that the market's actually starting to price in rate hikes in 2027. But at least you're pulling away from the potential of rate cuts because inflation is too high. So that could negatively impact like IWM related names at a certain point. So I've been telling the team very broadly, I still really like this kind of pairs trade of IWM short versus QQQ long. It's just a matter of timing the execution. So I've been talking about that trade for over a week now. So hopefully some people are already in it. If you're only looking at it right now, I still like the idea behind it. But at this point, the Qs are just way too extended to consider buying them. And the IWM today is actually playing a little bit of catch up. So there's definitely an inflation concern, but that inflation concern just means that the market's running too hot. And that only begins to matter when interest rates begin to increase. And we're not at that point right now. So given that things are just running super hot right now, that inflation is running hot, but we have no hikes ahead of us, and you've got $1 trillion stimulus coming from CapEx, you want to be long this market as long as you're not chasing price by too much. You want to be buying those flags, buying those pullbacks as a general rule, and you want to be buying leaders, and that's where we're at.
If you can, let's pull up some charts. Maybe we can look at them. Some of these chip makers like Micron, for example. These stocks are, as you mentioned, extended for sure. They're just continuing to run higher and higher. So when it comes to names like that, you don't have like moving averages necessarily to trade off of. So can maybe just walk us through how you would look at an overextended chart and how you find levels to trade off of when you are so far extended above the moving averages that you would typically use when it comes to a trade.
Sure. So we got the screen share going on here. I just pulled up Micron because you mentioned it, and it's definitely one of the culprits of pretty big upside extension here. The chart is beginning to go parabolic. I would say that you do still have that these moving averages.
Even that one you do.
Mm-hmm. Even though they're very far away from price right now, I think that these moving averages are still really important because these moving averages, the blue is my 80 EMA, the red is my 21 EMA. The space between the 8 and 21 EMA is what I consider to be technical equilibrium for any stock that I'm looking at on any time frame that I'm looking at it. So here on the daily chart, when I've got Micron trading at 790 with the 80 MA at 662, there is a lot of extension there because of the rate of acceleration in Micron. And again, I would argue that fundamentally these prices actually make sense for this stock and for a lot of the similar names. Technically, this is ridiculous though, and they need to correct. So probably the better, smarter trade is really to wait for the long setup to come in. How does the long setup come in? Well, long setup comes in when the stock has time to correct. There's two ways in which extension can correct. It can correct through time or it can correct through price. So Micron could just go sideways here for, it probably would take a while, a week or two, and this 80 EMA will slowly catch up. This 21 EMA will slowly catch up to price, and that's called a bull flag. What a bull flag is a time correction of extension. And then that bull flag is a technical bull setup that you would want to buy. Or we get some sort of a technical pullback. That's a price correction. The stock goes down. And then when the stock goes down, when it starts to get into that equilibrium zone, that 8 and 21 EMA, then you can look for a pivot low. There's a couple pivot formation patterns I like. One is what's called a continuation hammer, where you get a hammer candle, which is a tail that's got a nice downside tail right into that equilibrium zone. You can go long when it's then on the way up versus that tail low. Or another one I like is if you have like a bigger red bar into this area and it was followed by an inside candle, and that inside candle breaks up, so you're getting an inside and up after a correction into the equilibrium zone. That's another pivot low formation that I like. So you can look for those as long setups to come in and buy them. What you don't do is you don't buy it here now. And you know what? This market has been so wild that might work. There's been plenty of circumstances over the course of the last month where chasing extension has actually paid you. But from my experience in trading for the long run, for doing this not just for one trade, but for a career, which is a series of trades over days and weeks and months and years, is that you don't chase price. Buying here is a terrible risk reward. If you got a price correction down to 650, which would be super healthy, and you're long from 800, you're going to get torched, even if eventually this thing goes back up. So you wait for the setup to come in that gives you that long opportunity. And in the meantime, for shorter term traders who have the ability to scalp or be in for shorter periods of time, maybe a day or a few days, there is the short that you can also look for to take advantage of this extension and take advantage of what is most likely going to be inevitable time or price correction. And in that type of trade, you just have to recognize that you are going counter trend, you're going counter momentum, and those can be pretty profitable trades. I know traders who make an entire career off of counter trend trading, as long as the execution is done properly and you're shorting it on the way down and you're shorting it versus a level so that you can manage your risk, and you're not just blindly shorting hoping that it has to go down because it went up so far so fast. That's the wrong thinking. So there are trades on both sides of these semiconductors based off of this extension. Shorter term shorts is a possibility that give way, I think, to longer term longs when those setups actually come in. That's Micron. SanDisk is similar, or EWI, which is the Korean ETF, which basically is two other memory names, is similar. Or you could look at like an SOXX or an SMH. I prefer SOXX because it's a little bit less heavily weighted towards NVIDIA. I think SOXX is like 8 or 9% NVIDIA, whereas SMH is like 19% in NVIDIA. So I don't like that it's overly correlated to one stock, especially because NVIDIA has been trading a little bit opposite to a lot of the other semiconductors.
I wanted to ask your opinion on NVIDIA, because it's definitely been kind of a laggard in the space, and other names have definitely been more in vogue, especially like AMD. Being really the AI leader. And then, of course, you have your storage names like your Microns, SMDKs, WDCs, et cetera. So what do you think about NVIDIA and the action we've seen in the stock in this recent, chip maker, storage, memory, all of that space?
Sure. So first of all, I've been super bullish on NVIDIA overall, and I remain super bullish on NVIDIA. I think it actually also trades cheap. And I think that the story of NVIDIA is going to turn into a story about its buyback, similar to how Apple is very much a story about its buyback. I think that NVIDIA is going to be morphing more and more towards that direction as well. They're a cash flow machine. That's not going to change. It probably doesn't belong trading at the highest multiple that it ever has in the past, but it's not a name that I want to be short. I've been long this thing since the March low with a profit target of 220. It finally got to 220 today. I liquidated my NVIDIA, so it was a heck of a trade. I will be reinitiating along on any pullback is my current game plan. NVIDIA, from my intel and my research, has kind of acted, you mentioned that it's lagged. It's kind of acted as like a cash register for funds to be able to buy other things, because everybody is already long NVIDIA, multi-trillion-dollar corporation. There's a lot of money sitting in it. So when people wanted to start buying, Intel and AMD and Marvell and AVGO and these other names that have been high-flying names that have continued to move higher, the main reason why NVIDIA has underperformed is because fund managers have been selling NVIDIA to raise cash to be able to buy the other semiconductors. So you are seeing on a lot of individual trading sessions, NVIDIA almost trade opposite to the rest of the semiconductors. When all the semiconductors are ripping, NVIDIA is underperforming. But if you look closely, you'll also see that on some of the days when the other semiconductors are actually a little bit weaker, that NVIDIA tends to outperform on those days. But overall, the semiconductor trade has just been so insane that people have been using NVIDIA as kind of their cash register to be able to buy other things. So that circles back to why I prefer to trade SOXX versus SMH. SOXX seems to be a little bit more of a pure play on trading the semiconductors overall, as opposed to SMH is so heavily weighted towards NVIDIA. And if NVIDIA is trading opposite of the other semiconductors, it makes it not as good of a trading vehicle, if that makes sense.
All right, so we've been on this record run in this market, led by mostly the chip stocks and the tech stocks. We haven't gotten earnings yet from NVIDIA. We won't until the very end of earnings season. But when it comes to how the names that have reported so far, the market's reaction to them, what does that tell you about the NVIDIA report coming up in a few weeks?
Sure. So we'll see if things change by the time NVIDIA comes out, because that's not that unusual. Sometimes we have like a theme for earnings season. We work our way through earnings season, and earnings season is basically over, and then NVIDIA comes out, and NVIDIA doesn't necessarily follow the theme, because once everyone learns what the theme is, that's when it loses its edge to know that information. So you and I have discussed in the past, coming into earnings season, how, from my experience, when stocks go up a lot into their earnings reports, a good earnings report is oftentimes not good enough because they've overpriced the stock into that report. So you might see small beats across the board, and then you might see the stock sell down because everybody was already anticipating that beat. It was only a small beat, and then everybody who's already long is then coming in and booking profit. That has not been the case this earnings season. Even in stocks that have gone up a lot into their reports, they're holding in great on those reports as a general rule. We're not really seeing the beat that then gets sold off very much at all. And I think that circles back to how underpositioned market participants were for this rally that has happened here for the S&P and the NASDAQ. If you go back to the end of March, which was only a little bit over a month ago, everybody was positioned for the end of the world back here. And you may remember, Greta, because I was taking the opposite side of that, and I was saying that we were probably going to go back to all-time highs, and I was also saying that we were probably going to be led higher by the semiconductors. But everyone was positioned for the end of the world here. No one had longs. Everybody had puts. Everybody was super hedged. And then as this market started to squeeze higher, it just created this massive positioning squeeze. The higher we went, the more buyers were forced to come into the market, because their puts are bleeding out. They don't own any upside. They have to chase into calls. The systematics are all buying at the same time as well. So it's been this positioning chase just to get back to normal. It's really been what this rally has been about. So that's why when you're seeing a lot of these earnings reports come out, it might look like, oh my gosh, the stock is up so much into the report, and then the report is good. Other quarters over the course of the last several years that might lead to a profit-taking sell-off, that has not been this way. Pullbacks have been very temporary, even if they come at all, and then we're just continuing higher. And that's because the profit takers aren't there, because they don't own enough to begin with. So they're forced to chase even more. And on top of that, this has been a particularly good earnings season. This earnings season has been great. Companies are crushing it. If anything, the outlier risk overall on this earnings season has been to the upside. Of course, you're still getting companies that get crushed because they missed, but it's been much more of upside pain on companies crushing their reports than I've seen of downside pain of a bad report being mixed in here or there. It's been a phenomenal earnings season. We're firing on all cylinders, which is just another reason to be bullish, by the way, as long as you're not overly chasing price and putting yourself into bad risk reward situations.
All right, you mentioned it at the beginning. We do have inflation data coming this week. The CPI is on, I think CPI is Tuesday, PPI is Wednesday, and then retail sales also on Thursday. So it is a big economic data week, a little bit of a smaller earnings week after the blockbuster weeks we've had the past couple weeks. So when it comes to this inflation data this week, what is the risk to the market? Like if we get a really hot number, are we in trouble? If we get a really cool number, are we in trouble? What do you think is the risk that we're facing?
So I think that right now, even though you're not really seeing it in the IWM yet, there's a little bit of relative weakness in the IWM, but overall, it's still been a pretty bullish looking chart. It has participated in the April-May rally, but obviously when you look at the chart of the Qs, has not gone up as much as the Qs have. But I do think that it is a little bit of a tale of two economies, a tale of two markets, if you will. The semiconductor trade, the AI CapEx trade, I don't know, Meta and Microsoft and Amazon and these companies that are spending all this money on AI, Google, and the benefactors of that being these semiconductor names, they don't care about higher inflation. They don't care. The downside of higher inflation in and of itself, just to make this clear, is actually not bad for the stock market, right? On a real basis, it is obviously, because if you get a 5% return this year, just to make up a simple number in the stock market, and there was 5% inflation, then you actually didn't really make anything. You kind of kept the same, but it does enable those prices just to continue to move higher. So inflation in and of itself isn't actually bad for the stock market. What's bad for the stock market is what we have to do to tackle inflation, which is raise interest rates. So if the inflation number comes in really hot, the question just becomes, to what degree does that increase expectations of raising rates? And who does that negatively impact? It doesn't negatively impact Meta, most likely, or Meta's CapEx spend, which means it doesn't negatively impact the semiconductors, because just think about it logically, right? All right, so inflation is higher for whatever reason. Meta's business is in advertising. How is Meta negatively impacted by, higher oil prices or higher inflation rates? The only way that they would be negatively impacted would be if their advertisers stopped advertising. It's just so far removed, right? So you need to get all the way through this cycle where inflation starts to hurt the consumer starts to spend less. Because the consumer is spending less, advertisers want to advertise less. Then Meta goes, ooh, we're starting to lose some degree of our revenue. What should we do? Should we make a little bit less money, or should we pull back on some of our CapEx spend? And then maybe they finally decide at that point in the cycle to pull back a little bit on their AI CapEx spend, which then negatively impacts semiconductors. It's just so far removed. There's so many steps to get to that process. But if you think about a mid-cap company, an IWM company, a small-cap company, they're right there. So inflation is high, interest rates go higher, their business is immediately negatively impacted because, well, their business may be relying on debt to finance their operations. And if that debt just became more expensive, then their business might not be viable in the same way, or it might be viable, but just at significantly lower margins. So when we talk about higher inflation, that can have a much larger impact on the IWM versus the QQQ, which has been why I've been generally calling for this pairs trade of short IWM versus long QQQ. So we'll see. The last CPI number wasn't too bad compared to expectations, but there are some concerns that that oil price is going to start to leak into inflation numbers. And I would note that on the surface of things, oil is outside of core inflation. So you might get like a really high headline inflation number, but the Fed doesn't tighten because of that. The Fed tightens because of core inflation, but there is a leak through on oil to aspects of core inflation at a certain point. The most basic example of that is when you think of airline tickets. When you're going to go fly, well, they have an input cost, and therefore they have to pass that higher input cost onto the consumer through higher ticket prices. Higher ticket prices do show up in the actual core inflation numbers that the Fed wants to pay attention to. So it may begin to create a little bit of an uptick of a situation that it just compounds what we're already dealing with tariffs and everything as well. So, the best way to lower inflation right now would be if we were able to end the Iran war and we were able to stop tariffs. But it doesn't seem like that's happening immediately.
It does not. All right. Derrick is a real trader, so you want to let him get back to that again. Like I said at the top, he is the head trader at T3 Trading Group. If you're interested in working with him and the team there, you can go to t3live.com/DOLive, fill out the form there, and someone from the firm will be in touch. Everyone that works with T3 Trading Group works with Derrick and his team on a daily basis there inside the ProDesk virtual trading floor. And that's where all of the prop traders work together. So again, Derrick, have a great rest of your week, and we'll talk next week.
Thanks, Retta. Talk to you next time.